You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It's 1/20/23. Hard to believe the month is rapidly approaching an end. So goes January. So goes the year. Well, that is an old saw on Wall Street. And we got somebody who's playing old saws for even more years than me. Jim Welsh, macrotides.com is with us. So, Jim, is that in fact true? So goes January, the so-called January effect. Most years, if markets finish up in January, they finish up for the year. Is 2023 going to be any different?
Well, there may be a valley in between the ups. Let me put it that way, Kerry. Again, the old saws are always fun to talk about at cocktail parties, but I kind of believe, like when we drive our cars, we don't try to guess what's going to happen, 12 miles down the road. We basically look at the 100 feet or so in front of our grill and drive the car accordingly. And to me, this is one of those years. So old saw or not, I think investors are going to have to kind of recognize that the FOMC is really serious about what they've said they're going to do. So that to me is the speed bump that we're going to have to navigate over the next 3 to 6 months. And I'm not sure the markets are going to take it without, getting bumped around a little bit.
All right. So we've talked quite a bit, and you are of the opinion that the Fed will be able to work its magic, break the back of inflation because they're so effective and they know what they're doing. But look, inflationary cycles go often for decades. If we go back to 60s, 70s, and 80s, that's a 25-year thereabouts cycle. And we had what finally broke it purportedly was two things: Volcker raising rates to nearly 20%, and he actually restricted the amount of credit that banks were able to issue. And that almost set the economy into a fatal tailspin. There's no way that Powell has the cojones that Volcker had, and 5%, 6%, 7%, maybe even 8%. How much higher can he go, and at risk of crashing the broader economy? And do you really think that's going to cure the inflation problem?
Well, there's a lot wrapped up in that statement. First of all,
but that's the way I
when you don't take a breath for like 2 minutes, then you've got a lot of statements in there. No, I think, to your point, back in 1981, federal debt as a percent of GDP was down around 60%. Now we're more than double that. Even with rates as they stand today, if they stay near these current levels, we're going to see interest expense as a percent of GDP, and certainly as a percent of the government spending every single year is going to rise significantly, where it's over $1 trillion per year. So there is a game of chicken going on in one regard, that there is a limit in terms of what the Fed can do in terms of raising rates. I think they're going to, and again, over the last 2-3 months, I've been talking about there was going to be a very sharp decline in headline CPI, primarily because of the takeaway values from last year. And we're going to see that even continue through March of this year. So, we're going to get inflation down to probably around 3% or so pretty quickly by the middle of this year. But again, I'm going to take the Fed at their word. They got a lot of mud on their face in 2021 and 2022 by talking about transitory inflation when it obviously wasn't transitory. And I think they're dead set, Kerry, in terms of sticking to their guns. And for whatever reason, Wall Street and a number of the financial markets don't believe the Fed is going to do what they're saying they're going to do. So if you look at the federal funds rate, it's looking for the funds rate to get up to about 4.87%. And then the Fed is going to be cutting rates in the second half of this year and early 2024 by 150 basis points. In the meantime, the Fed, in their projections in December, said, no, we're going to raise the fund rate to 5.1% and hold it at that level all through 2021. So I just think that the Wall Street is not, they just don't believe the Fed. And I think the Fed is very intent on following through. And the point being is, I think there's going to be a recession this year, not just the yield curve. If you look at the leading economic indicators down 9 months in a row and the magnitude of the decline that it has experienced, there's always been a recession. And lastly, banks are increasing lending standards. So now they're starting to restrict, if you will, the availability of credit. Again, whenever it's reached the level it did in the third quarter, a recession has followed. So to me, the probability of recession is very high. The rough spot, I think, especially for equity investors, is going to be when we get more real evidence that the economy indeed is slipping toward a recession and the FOMC does not blink. Wall Street has been conditioned the last 20 years. Hey, every time the economy stutters a little bit, the Fed comes to the rescue. With inflation where it is, they're not going to do that. And that's why I think in the second quarter, the S&P is vulnerable to a decline that could take it down towards 3,200. The ultimate test is, okay, inflation comes down to 3% or so late this year, early next year. What does the Fed do at that point? And, again, most people are betting that they're going to move the goalposts and say, well, 3% is just fine. We'll see. I'm not willing to go there. Yet I think there's a lot of time between now and when that bridge has to be crossed. In the meantime, in the short term, the Fed's going to stick to its guns, and the markets sooner or later are going to wake up. Just like when Powell did his Jackson Hole speech, everyone was expecting something different, and he came through and really said, no, we're serious. This is what we're going to do. And obviously it had repercussions for markets as a result. So I think that's the misconception here, Kerry, is that Wall Street thinks the Fed's going to cave. And honestly, if you listen to what these people are saying, they're pretty resolute in terms of their conviction that they're going to hang tough for a period of time. And that's, I think, going to be the stumbling block for the markets.
I don't know, Jim. You got like a lot more confidence in these guys. So you think they'll actually crash the economy and they will actually crash the global economy? We're not just effectively, let's face it, the Fed is the world's central bank, for better or for worse, for now. That's not always going to be the case. And if it comes to crashing the euro and destroying economies across the globe in the name of protecting the dollar, they're going to do it.
Again, I think there's a huge gap between what I just said and crashing the economy. Huge gap. A lot of time. So my point is, I don't know if they're going to cave in at some point in time. I mean, at some point in time, the trade-offs become such where you say, you know what, we've got to, again, if there's a financial crisis of any magnitude, the Fed is going to respond to that. That's their job. Lender of last resort. So if we are on the verge of a crash in the economy, of course the Fed is going to reverse course. All I'm saying is that the economy's hanging in there pretty good. Consumers still have, the bottom 30% of wage earners have burned through most of the savings that they had coming out of the pandemic, is working its way up the income ladder. But I think by mid-year, those savings are going to be gone. The full impact of the rate increases that the Fed has enacted are going to hit the economy. So I think, again, there's a recession coming. There's a difference between a recession coming and a crashing the economy. They are and would absolutely respond to a crashing of the economy. Will they be quick to respond to a slowdown that starts to look like a recession? No. Now, maybe that leads to a crash, but you take it one step at a time. Even if it is only a slowdown recession and the Fed doesn't respond the way Wall Street has been kind of trained the last 20 years, there's a lot of people who have been running money for 20, 30 years. They've never experienced inflation at a 40-year high. So I just think that the assumption that the Fed isn't going to follow through on their saying what they've been saying resolutely is wrong. Likewise, to say that they're going to allow the economy to crash and not respond, well, that's wrong too. They would respond. Again, we got to go somewhere in the middle here and assume what is the most likely course over the next 6 to 9 months. The most likely course, I think, is that we're going to see the U.S. economy work its way into a recession. The initial stages of that, the Fed isn't going to be quick to do an about face. If that recession turns out to be deeper than expected for whatever the reason, and there's global strain starting to show up, yes, the Fed would respond. But, again, from a bell-shaped curve, I think the more likely outcome is the next 6 months, we're going to see the economy move toward a recession. And in the initial stages of that, the Fed isn't going to be quick to reverse. And there'll be implications for a lot of markets for that.
Okay, so that's one. But do you really honestly believe that the Fed is going to break the back of inflation through the current program of interest rate increases? You really think that's going to happen?
Don't just survive, thrive. The Financial Survival Network.
Torq Resources is an exploration company establishing a portfolio of premier copper-gold early-stage projects in Chile. Torq's management and technical teams have a strong track record of raising capital, discovery, and monetization of exploration successes. The company's Margarita copper-gold project is located within the prolific coastal Cordillera Belt in Chile, which hosts some of the world's largest and most profitable copper mines. The Margarita project possesses excellent discovery potential for a major copper discovery due to the strength of the alteration system, large-scale magnetic targets, and the presence of copper oxide mineralization. Drilling is anticipated to begin in Q3 of this year. Torq trades in Canada under TORQ and on the OTC under TRBMF. To learn more, go to torqresources.com. That's torqresources.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
I don't know. Again, I think there's some real reasons why it's going to be difficult. In other words, getting inflation down to 3%, I think, is definitely doable and likely. The problem with getting it from 3% down towards 2%, there are a number of problems. The labor market tightness that the Fed is saying they're focused on has been building for 20 years. If you look at the labor participation rate, it's been dropping for 20 years. So this problem of labor market tightness has been building for decades. It's not going to go away overnight because you still have a lot of people getting older. They're retiring. They're not coming back into the labor force. The other issue, high energy prices. Well, historically, the last 50 years, whenever energy prices went up a lot, oil and gas firms increased their budgets to explore, get more wells developed, and then produce more oil and gas, which subsequently brought oil prices down. In the 70s, oil got up to about 39. By the mid 80s, it was down under 10. Same thing what we saw 2014 to 2020. Oil prices were 110, 120, and they came down to under 60. The difference here is that because of politics and a lot of other things, oil and gas companies, not just in the U.S., but globally, have not been investing the way they have in the past when oil prices were high. So you're going to have a natural constraint on supply over the next 5 to 10 years. My guess, that's likely to keep energy prices higher than otherwise has been the case, especially going back the last 50 years. And lastly, globalization. For 20, 30 years, globalization, we actually saw deflation in goods prices for much of the last 20 years as production went to China and other places overseas. And we're seeing that whole effort of globalization unwind as production leaves lower cost places, some of it coming back to the U.S. So the tailwind, if you will, for inflation staying down from globalization, that has shifted. And so to me, those three factors, Kerry, go to your point that, inflation is going to come down to a certain level. And then those things are going to make it more difficult to get it from, let's say, 3% to 2%. And at that point in time, we'll see what the Fed does. I'm not saying they're absolutely going to hold the course and all that. I just think that we've got to first navigate the next 6 to 12 months in terms of what's likely to happen with the economy in their initial response. As we go out longer into late this year, early next year, the things are going to look different than they do right today. So I don't disagree with the point you're making that inflation might come down, but it's not coming down to 2%. And then, how the Fed responds to that is going to be kind of telling. If they choose to accept higher inflation, I can't imagine that bond investors are going to be happy. That would imply Treasury yields going back up, irrespective of what the Fed does. So, there's a lot in motion here. And as I said before, driving a car, we just want to look out in front of the grill of our car and try to make sure we don't run over anything or run off the road. What I've laid out is, I think, the roadmap for the next 6 to 9 months of the path of the economy and what the Fed is going to do in response.
Right. Okay. Well, we'll see if they really can control things, or at least give the illusion of control. Maybe that's more important than actually doing it. And if the forces of inflation that they've unleashed into the economy, both in the U.S. and abroad, whether they can put that genie back in the bottle or the toothpaste back in the tube or whatever twisted analogy you want.
Yeah.
I'm skeptical of it because they've only got basically, it's like a car. They got 2 pedals, accelerator and brake. Now they're trying to hit both of them at the same time. And what happens when you're in your car and you hit the brake and the gas at the same time? Usually you wind up hitting a brick wall.
Or spinning out. No, I don't disagree with the point you're making. All right. I just finished a piece called The Coming Secular Bear Market. And the whole idea of that piece is to look at some of these longer term trends in terms of debt, the velocity of money, demographics slowing, not just in the U.S., but globally, and what that means for economic growth, both here in the U.S. and globally. And so to me, there's a lot of things coming together, Kerry, that I think are going to result in a secular bear market in the stock market. And going back to 1966 to 1982, if you look at a chart, you'll see the Dow hit 1,080 in 1966 and was under 800 in 1982. So it was a combination.
Yep. I actually remember that. I was alive then.
That's good. That's good. And more importantly, you're still alive now to remember it. No. Yeah. So my point, Terry, is I'm not dismissing what you're talking about. It's we're just trying to take it one step at a time, so to speak. But from a bigger picture and the point you're raising, I think a lot of things are going to come together to cause a secular bear market. So if listeners would like to read that piece, all they have to do is send me an email to jimwelshmacro@gmail, and I'll send that to them. I think they'll find it very informative. And obviously the whole world, for the most part, is focused on buy and hold. Because, hey, we've been in a secular bull market for most of the last 40 years.
Well, the stock market always goes up.
Strategy. Yes. Yeah. And if you miss the 5 best days, your returns are terrible. Well, that is so disingenuous, because if I put together a study that said, look at what happens to your returns if you miss the 5 worst days, and most years, the 5 largest declines add up to a much bigger total than the 5 biggest advances. But again, that would be just as disingenuous as saying, well, if you miss the 5 best days, that's why you have to buy and hold and hang in there. I agree with that. But when you get into a secular bear market, buy and hold does not work as the way it does, obviously, during a bull market. So to me, I'm not disagreeing with what you're saying. Bigger picture, again, I'm just trying to say, okay, what can I reasonably foresee in the next 3 to 6 months? And, as I've said, I think the Fed is going to resist, the initial wave of any kind of a recession. And ultimately, what will they do if inflation only comes down to 3%? Well, when we get to that point, I'll try to make a good guess.
All right. Well, I think we got the world according to Jim Welsh here. What do you think?
Can I touch on one thing?
Yeah, please.
One thing, okay? If you look at the dollar topped in October, all right, and it's been correcting from 114.70 down to 102-ish. And what happened to all the other markets? Well, Treasury yields topped in October. Gold bottomed in October. The stock market bottomed in October. I think the dollar is nearing a good trading low. A lot of people around the world believe the Fed isn't going to follow through. I think that's why we've seen dollar weakness, why we've seen rallies in the other markets. Technically, the dollar is coming down to a longer-term trend line. I think there's a bounce coming in the dollar, Kerry, based on a, if you will, a re-estimation that maybe these guys are serious. What that implies to me for gold is that it's near a high. I'm expecting a pullback under 1830 to maybe 1800. I think the S&P is going to be vulnerable. As I said, in the second quarter, I think the S&P could see a decline towards 3,200, which is the 61.8% retracement of the rally from the March 2020 low at 2,200 to the high we saw January of last year at 4,800. I think Treasury yields are likely to tick higher. An interesting thing is if you look at the 10-year, it made a lower low this week versus the last 2-3 weeks. The 30-year did not. So you have what's termed a intermarket divergence. And typically, Kerry, those things, especially in the Treasury yields, have shown up near a change. So my point is that we've seen these big moves over the last 2-3 months, but people are expecting the Fed to cave. And I think the Fed's going to push back on that, and we're going to see reactions in all the markets with the dollar rebounding and other markets fading. So that's how I try to tie the fundamentals with the technical stuff.
So gold's coming down, and is that a long-winded way of saying that?
Yeah, but then I think it's going into new highs. I think it's going above 2,100. So it's kind of like this rally from 1616 to 1935, I believe, is wave one. Wave two pullback towards 1,800, and then I think gold is going to make a move above 2,100. That's my guess.
All right, I like the way you think, Jim. We had to put you to the test of that because Brandy, one of our listeners, said this guy thinks the Fed is superhuman and they can do anything that they set their minds to, and really, I had to pass that along to you. Thank you for that, Brandy. We do. Yeah, well, let me pass this along to Brandy. Okay, I've been a big criticizer of the Fed. Historically, if we look at all their projections of the federal funds rate, the economy, inflation, they're right less than 1/3 of the time. All right. So I don't put a great stock on balance. I mean, when Powell was saying inflation was going to be transitory in June of 2021, I'm saying, no, it's not going to be transitory. So I'm not afraid to criticize the Fed and acknowledge the fact that they have great limitations. But what I see here is a Fed that's determined in the next 6 months to do what they think they should do to get inflation down, and the markets don't believe it. And if I'm right, and the Fed sticks to the guns over the next 6 months, the markets are going to react to that, just like they reacted to Powell's speech at Jackson Hole. So I'm just trying to see it as it is. Believe me, I'm not a huge fan of the Fed, but I just, so thank you for that comment, Brandy. I appreciate it. How could you be a huge fan of the Fed? They've wreaked so much havoc. And look, we talked about this. If they had started 18 months ago, or maybe 2 years ago, when it was obvious with all that money pumped in, they didn't need to do much. Just cutting back on mortgage-backed security purchases because the real estate market was booming, raising 25 basis points once per quarter or every other month. Okay.
Sure.
The market would have accepted it. We wouldn't have needed the shock treatment, and we would have a lot different looking world here. What's your take on real estate? So the rates are going up, but they're going to come down, aren't they?
Well, ultimately, I still think if you look at prices relative to income, they are very, very stretched. And so my expectation is housing prices are going to come down 10 to 15%. I don't think we're having a 2008. I think the real risk with real estate, Kerry, is overseas. If you look at charts that show the U.S. valuation of real estate housing relative to New Zealand, England, a number of other big countries. And a lot of those countries have a high percentage of variable mortgages. Well, we had that in 2006 and 7, and that didn't turn out well when all those mortgages got ramped up in terms of people having to pay the higher rate. So to me, if there's one of the risks out there, surprises could be that, there's another housing problem. It doesn't start here. It starts overseas. One last thing, I think, again, in terms of branding, because this is something I've said repeatedly over many years. The Fed wants a goal of 2% inflation. Well, guess what? The cost of living doubles every 36 years with inflation rising at 2%, which the Fed calls stable. In 72 years, it's quadrupled. So the average person lives between 75 and 80 years. So that means in a lifetime, the cost of living is going to quadruple. So to me, it's ludicrous. Even the Fed's 2% target is ludicrous when you look at it. Wait, that's stable prices. I paid for $1. Something cost $1 when I was born, but now when I'm 75, I'm paying $4 for it. That's stable. So again, I have a big problem with monetary policy and some of the things that they've laid down as being, almost gospel. But it is what it is. And I think I just try to analyze what they're saying, what they're going to do. And when I don't think they're going to be able to follow through on something, I've been pretty critical. I just think in the next 6 months, these guys are resolute. Whether or not they're going to be able to really bring inflation down enough, we have no idea. We can only make it, hopefully, intelligent guesses,
Yeah.
So.
Semi-intelligent guesses, right?
Hopefully. At least hopefully the glass is half full on that regard.
Yeah. Hey, well, it's always full. It just might have half liquid and half air, but the glass is always full. Never forget that.
Okay. There's things that are popping into my mind, but I'm going to keep my mouth shut. So again, I just want to reiterate, if somebody wants to get this piece, The Coming Secular Bear Market, send me an email, jimwelshmacro@gmail.com. Again, it ties into, I think, one of the themes that Kerry has likely been talking about for quite a while, that there's troubles in River City. And I don't know that the Fed is going to solve, or any of the central banks are going to be able to solve it, because in part, they contributed to them in the first place.
Yeah,
so
they're the
anyway,
direct cause of it. But let's not let the federal government off the hook and the fiscal side of things, because we've been running these unsustainable deficits, printing up
for a long time,
for decades now, and nothing that I see on the horizon is going to change that. Hey, Jim, macrotides.com. Make sure you go take a look. If you've got a question for Jim, thank you again, Brandy, for that question. Shoot me an email, kl@kerrylutz.com, and make sure you click the link in the show notes to this interview to get to Jim's site. And while you're there, financialsurvivalnetwork.com. Sign up for your free newsletter. Jim, always a pleasure. Can't thank you enough for coming on. We'll talk to you again real soon.
Hey, this was fun, Kerry. I like it, a little back and forth, and hopefully I think your listeners will have got some value out of it. So thank you, and Happy New Year to you and everyone else.
Well, they'll definitely get value because they're not paying anything for it. So you get the benefit of two old guys' wisdom about the markets for free. Take it at your own risk. All right, Jim. Thanks. Happy New Year.
Take care, buddy. Yeah, thank you.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.